What if I told you that almost every dollar in your wallet wasn't created by the government, but by banks? And the system is designed so the debt can never be paid back. If you want to understand how money really works, hit that like button and subscribe to MacroLedger so you don't miss future videos breaking down the financial system. Every government on Earth owes money, trillions, and that number keeps growing, year after year, decade after decade. You've probably heard people say this can't last, that eventually someone has to pay it all back, that we're passing the bill to our kids. But here's what almost no one tells you. The debt doesn't need to be paid back, not in the way you think. And the system was never designed for that to happen. In fact, trying to pay it all back would likely cause an economic collapse. This isn't a glitch. This is how modern money works by design. And once you see it, you can't unsee it. This matters right now, because inflation, debt, housing, and inequality all trace back to this single mechanism. So let's strip it down. No jargon, no theory, just the machine as it actually runs. Start with a basic question. What is money? Not philosophically, practically. Money is numbers in accounts, ledgers, balances that move. Physical cash exists, but it's a rounding error. In most developed economies, over 90% of money is digital. It's not printed, it's typed into existence. Now here's where the story gets uncomfortable. When people imagine money creation, they imagine a government pressing a button. But governments don't create most money. Banks do. Not central banks, regular banks, the kind with apps, branches, customer service lines. Here's how. You walk into a bank and ask for a loan, a mortgage, a car loan, a business loan. You think the bank takes someone else's savings and lends them to you. That feels logical. It's also false. The bank does not check a vault. It does not move existing money. Instead, it creates new money out of nothing. When the loan is approved, the bank simply adds numbers to your account. Those numbers did not exist before. At that exact moment, new money enters the economy. No printing, no taxes, no government approval, just a keystroke. This is not a loophole. This is not a trick. This is how modern money works by design. Banks are licensed money creators. Now pause for a second and think about the scale. Every mortgage, every corporate loan, every credit line, each one creates new money when issued. And when loans are paid back, that money is destroyed, deleted. Money doesn't slowly circulate forever. It expands and contracts with debt, which means the money supply is not controlled by how hard people work or how productive society is. It's controlled by how much banks are willing to lend. And that willingness changes with fear, confidence, and incentives. This is where the government enters the story. Governments do create money, but mostly indirectly. Central banks don't decide how much money exists. They influence how easy it is for banks to create it. Interest rates, regulations, liquidity support. Think of central banks as traffic signals. They don't drive the cars, they change the lights. Banks decide how fast to go. Now here's the irony. When governments spend more than they collect in taxes, they borrow. They issue bonds. Who buys those bonds? Banks, funds, institutions. And how do banks buy them? Often with newly created money. So even government spending loops back through the banking system. The myth is that governments print money and banks react. The reality is banks create money and governments manage the consequences. This system wasn't created in secret. It evolved, piece by piece, crisis by crisis. And it creates a strange incentive. Because banks earn interest on money they create, if you create something at almost zero cost and get paid interest for decades, you're motivated to do it again and again, but only if it feels safe. Which is why banks prefer lending against assets, especially real estate. A house doesn't disappear. Stocks fluctuate, wages stop. So credit flows towards assets, not productivity. This is one reason housing prices explode while wages lag. It's not greed alone. It's the structure of money creation itself. Now zoom out. If money is created through debt, then debt must keep growing. If debt stops growing, the money stops growing. If money stops growing, the economy contracts, which means the system requires continuous borrowing just to stay stable. This is the uncomfortable math no one campaigns on. Debt is not a bug, it's the fuel. Before we continue, if you're finding this valuable, make sure you're subscribed to MacroLedger and hit that like button. It helps us reach more people who need to understand how the system actually works.
Now, think about crises. In good times, banks are confident. Loans flow, money expands, assets rise. In bad times, banks panic. Lending freezes, money contracts, everything breaks at once. This is why recessions feel sudden. Money disappears faster than it was created. And when that happens, everyone looks to the government. Why don't they fix it? Why don't they just create money? They do, but usually too late, and often in ways that stabilize banks first. Not because of conspiracy, because banks are the plumbing. If the plumbing collapses, nothing flows. So, governments step in. They guarantee deposits, they backstop loans, they inject liquidity, which often looks like bailing out the same institutions that caused the problem. And this feeds public anger, understandably. But the deeper issue isn't morality, it's architecture. We built a system where money creation is privatized, but risk becomes public during collapse. Now, let's address the obvious question. If banks create money, why don't they create infinite money? Because constraints exist: capital requirements, regulations, borrower creditworthiness. But the strongest constraint is demand. Banks can only create money if someone wants to borrow, which means confidence drives money supply. Optimism creates money, fear destroys it. That's not how most people think money should work, but that's how it works. This also explains inflation in a different light. Inflation isn't just too much money, it's too much money chasing specific assets. When credit floods housing, prices rise. When credit floods markets, bubbles form. When credit flows unevenly, inequality widens. Not because money is evil, but because it enters the economy at specific points, not evenly, not democratically, quietly. Now, zoom out one final time. Who controls the future economy? Not voters directly, not politicians alone. The future is shaped by lending decisions today. Which sectors get credit, which don't, which risks are rewarded. Money is power, and power flows through balance sheets. This doesn't mean the system is doomed, but it does mean most debates about money miss the core mechanism. We argue about taxes, budgets, spending, while the majority of money creation happens elsewhere, behind interfaces, inside databases, with incentives few people ever examine. So, the next time you hear someone say the government is printing money, pause. Ask a better question. Who is actually creating money right now? And more importantly, who decides where it goes next? If this changed how you see money, subscribe to MacroLedger for more videos exposing how the financial system really works. And let me know in the comments, who do you think controls money creation?